Hi everybody, I hope everyone's well. The year is skipping by. We're nearly at end of financial year, of course, and I thought there's been a couple of things on the go. I thought it would be worthwhile saying g'day, checking in with a quick video. I always say at the beginning as well that the contents of this video are just an opinion only, a general view, and not to be applied to your own circumstances without first making sure that anything I talk about is applicable to you. So best way to do that's obviously to be in touch with me, and we can see how it best works for you. All good. I think probably the big thing for the last few months has been the turbulence in the markets and all the economic news. Every day we're seeing something new, primarily out of the States. You will have seen as well, if you do pay attention to it closely, that in sort of mid-February the market started to fall off with that Liberation Day announcements, where the tariffs were announced were much more widely applied and much higher than expected, and I've done a video about that as well. But since then we've been really pleased to see how the markets have bounced back, and that those losses on paper even have been pretty much recovered now, and we've been really pleased throughout that to see how our portfolios have behaved. That side of things we're comfortable with. I think I said in that last video that we knew the cause for this problem, completely unlike COVID or other things before. So it was a matter of being appropriately invested and then allowing time for markets to adjust, or it was more often the case for announcements to be backtracked and changed. And so I think maybe too there's a case for whether markets stabilise. I'm not sure. There's bound to be plenty more volatility because of the unexpected, unpredictable nature of things nowadays. But I think the markets too are not knee-jerk reacting as much as they initially were, because seems apparent that things are said or announced and then changed later or backtracked or whatever. So. We had an investment committee meeting, a quarterly investment committee meeting a week ago at the end of last week, and the news out of that, I'll give you some takeaways from there, but fundamentally the news was that we're taking a calm and considered approach to things. There's no immediate changes to anything. We're not suggesting out of one sector into another or anything that might be considered dramatic. So we're just continuing to watch as we have been and look at themes that might change, and also then apply it to individuals. As much as anything at the moment we're sitting there thinking, well, it's our individual review meetings and your own circumstances that might drive changes when there's a fair bit of uncertainty in markets otherwise anyway. So like I said, we're quite relaxed about things. We'll watch things progress and see how things go. We're a couple of quick takeaways. We with the way inflation's going, there was a rate cut in May that we saw. So the reduction, we're expecting interest rates, the Reserve Bank to cut rates further, maybe even another up to 4.25% cuts between now and into 2026. So that's one of the thoughts that came out of our investment committee meeting. Interesting one too is that the outlook for Australian equities and for growth is potentially being tapered down a little due to the uncertainty, tariffs and other things. What we think it might mean for Australian markets is that while markets as a whole might sort of suffer broadly, we think that those individual sectors and will present opportunities, because not all areas are affected equally. So we think there's a fairly compelling opportunity there for active managers, and as we've said plenty of times before, we prefer active managers. We just have to pick the good ones. So we want active managers to be able to take advantage of market drops as opposed to just following the market and selling things off. And so we'll be focusing a lot more on active manager selections and those kinds of themes. The US economy we're expecting to slow down a little bit, unsurprisingly, and there's a fair range of outcomes there depending on how far things are allowed to go before there are adjustments made. So a growing concern there. But we're also thinking too that global growth all round has been, all developed markets globally have been revised down, not just the US. So that's something to watch. We also think too that markets, as I said, have sort of dropped and then recovered, that V-shaped recovery as well. But we don't know if that's to continue. Of course, there's more water to roll along there. So, you know, there's been a lot of pro-growth strategies promised that haven't yet come through yet. That big beautiful bill is sort of hanging in abeyance at the moment. It'll be hard economic data, we think, rather than soft data that sort of dictates where the US market goes. So once again, it's a bit of a wait and see. You might recall from the last video on this topic is that when we have these quarterly meetings, we sort of set what we think is our view or scenario likelihoods looking ahead. And if you can picture it now, we've got sort of on the pessimistic side, you know, a recession as a result of all this. Up until the last couple of weeks has been sitting at about 30% likelihood, which means that the two more optimistic scenarios are just a sort of muddling along steady decline. We've had it about 50%, but then a more optimistic where growth stabilises and markets bounce back and the economies start humming along again. That was about 20%. So look, the average to more optimistic view we have is, you know, about 70% likely, with about a 30% likelihood of things turning south. But we think in all of that, on that middle scenario, the Federal Reserve's going to be more reactive than proactive with regard to rates. They'll see what inflation does and raise rates if they need to. But conflicting all of that and what might drive reactions in the meantime is that, you know, with big debt and everything else, US needs rates to be low. So they've got to fund that debt. So look, we think, if anything, as things unfold, our view, for what it's worth, is that we think that that likelihood of steady, you know, muddling along, average, maybe a slow decline might improve, and that percentage that we're thinking, you know, up until now has been, you know, negative, might start shifting across and improve things there. So look, that's the view. Things change, so we'll keep an eye on it, but at the minute I guess it's useful to know that we're not sitting here wringing our hands pessimistically about things. Look, I didn't want this video to be too long. I hope that's a reasonable insight into the way we're thinking and the approach we have and the outlook we have. What I would also say too, with end of financial year approaching, people in some cases, if it's appropriate, and sometimes accountant-led, talk to think about making extra super contributions and that kind of thing. One of the young fellas here, Nick, has spent some time doing up a little tutorials, I guess, little guides, step-by-step guides to show you how you can access some of the reporting, ATO reporting on super contributions, HECS, you know, university study payments and things, to do that online via your MyGov login. So we've attached 4 PDFs that cover different topics there. If it's of interest to you, it'll help. It might spark an interest or a question, of course. Just give us a buzz and we'll help you out. But anyway, approaching 9 minutes now. Thanks for your patience. I hope that was useful, and take care, and we'll chat soon. Bye-bye.